Imagine waking up tomorrow and discovering that your investments just deposited $1,000 into your account this month, and you didn't work an extra hour to earn it. No boss, no overtime, no second job, just money generated by assets you already own. Now, here's the part most people get wrong. They think you need to be a millionaire before you can create that kind of income. You don't, but you do need a realistic plan, patience, and a portfolio designed to grow over time. In this video, I'm going to show you how someone starting from scratch could work toward a $1,000 a month dividend income goal, how much money that goal could actually require, what kind of investments can produce it, and the biggest mistake that could turn a smart dividend strategy into a financial trap. And stay until the end, because I'll show you why chasing the highest dividend yield can actually move you farther away from your $1,000 a month goal. First, let's make the goal simple. $1,000 a month sounds like a salary, but dividend investors usually think about it as $12,000 a year. That means your portfolio needs to generate roughly $12,000 in annual dividend. The amount you need to invest depends heavily on the portfolio's average dividend yield. For example, if your portfolio generated an average yield of 3%, you would need about $400,000 invested to generate $12,000 per year. At a 4% yield, the number falls to around $300,000. At 5%, it's around $240,000. But there's an important warning here. Higher yield does not automatically mean a better investment. A company paying a huge dividend may have serious financial problems, and sometimes an attractive yield is actually a warning sign rather than an opportunity. So the goal isn't simply to find investments paying the biggest dividend. The goal is to build a portfolio where the income has a reasonable chance of growing and continuing over many years. Now imagine two investors. The first investor sees a stock paying a 10% dividend yield and thinks, perfect, I only need $120,000 to make $12,000 a year. The second investor chooses a diversified portfolio of established companies and funds with lower but potentially more sustainable yield. The first investor might look smarter on paper at the beginning, but if that 10% dividend gets cut, the entire plan can fall apart. The second investor may start with less income, but if the underlying investments increase their dividends over time and the portfolio itself grows, the income can become much more powerful. That is the difference between chasing income and building an income-producing asset. So how do you actually start from zero? You start by changing the way you think about the first $10,000. Your first goal is not $1,000 a month. Your first goal is building the habit of buying productive assets consistently. If you invest $200 a month, you're not going to wake up next year with a $1,000 monthly dividend check, but you are building something far more important: ownership. Every time you invest, you are purchasing a tiny piece of businesses or funds that can potentially generate profits and distribute some of those profits to shareholders. Your first dividend payment might be $3, then $8, then $15. Eventually, if your contributions and portfolio grow, those numbers can become hundreds or even thousands of dollars. This is where consistency becomes more important than excitement. Let's say someone invests $500 every month and earns an average annual return of 8% over the long term, with dividends reinvested. That person could potentially build a portfolio worth hundreds of thousands of dollars over several decades. The exact outcome will depend on market performance, fees, taxes, contribution timing, and many other factors, so 8% should never be treated as a promise. But the lesson is powerful. Your money can potentially start earning money, and then those earnings can be reinvested to buy even more assets. That creates a compounding effect. You're no longer relying only on your paycheck to build wealth. Your portfolio begins participating in the process, and this is where dividend reinvestment plans, often called DRIPs, can become interesting. Instead of taking a $20 dividend payment and spending it, you can reinvest that money into additional shares, depending on your brokerage and investment choice. Those additional shares can potentially generate more dividends in the future. Then those dividends can buy more shares. It's a simple concept, but over a long period, it can become incredibly powerful. The early years may feel boring because the numbers are small, but compounding is often boring before it becomes impressive. Now let's talk about what could actually go inside a dividend portfolio. Many investors use a combination of individual dividend-paying companies, dividend-focused ETFs, and broad market funds. An ETF can give you exposure to dozens or hundreds of companies through a single investment, which can reduce the risk of relying on one company. For someone starting from scratch, diversification can be especially important because you don't want one company's earnings problem, dividend cut, or industry downturn to destroy your entire income strategy. The exact investments depend on your goal, risk tolerance, taxes, and time horizon, but the principle remains the same. Don't build your entire financial future around one dividend payer simply because its yield looks attractive today. There's another decision that can completely change your strategy: where you hold these investments. If you're in the United States, you might have access access to accounts such as a 401k, traditional IRA, Roth IRA, or a regular taxable brokerage account. These accounts can have very different tax rules. For example, a Roth IRA generally allows qualified withdrawals to be tax-free, while a traditional IRA generally provides tax-deferred treatment, and a 401k can offer tax advantages depending on the plan. A taxable brokerage account is more flexible, but dividends and capital gains can have tax consequences. The IRS rules are detailed and can change, so you should always check current IRS guidance or consult a qualified tax professional before making decisions based on taxes. The key idea is that building wealth isn't only about what you earn from your investments. It's also about understanding how much of that money you actually get to keep. Now let's get to the question you're probably asking. How much should I invest every month? There is no magic number because everyone starts from a different financial position. Someone investing $100 a month will move more slowly than someone investing $1,000 a month, but both are moving in the same direction. If you can increase your contribution as your income rises, the journey can become dramatically faster. Imagine starting at $300 a month, then increasing it to $400 after a raise, $500 after paying off a debt, and eventually $750 or $1,000 as your income grows. Your biggest advantage isn't necessarily finding the perfect stock. It's increasing the amount of money you can consistently put to work. And here's a strategy many people overlook. Don't immediately focus on making your portfolio produce $1,000 every single month. Dividends aren't always paid monthly, and many companies pay quarterly. What matters is the total annual income your portfolio produces. If your portfolio generates $12,000 a year, the timing of those payments doesn't change the annual amount. You can think of your $1,000 monthly goal as an average annual income target rather than expecting exactly $1,000 to hit your account on the first day of every month. Now imagine you've finally reached $100,000. At a hypothetical 4% portfolio yield, that would represent roughly $4,000 a year, or about $333 per month on average. You're still far from $1,000, but something important has happened. Your portfolio is no longer tiny. The assets themselves are now generating meaningful cash flow. If you continue contributing and reinvesting dividends, you're combining three potential wealth-building engines: your new contributions, the growth of the investments, and the reinvestment of dividend. That combination is what can potentially move you from hundreds of dollars in annual income toward thousands. But there's a psychological trap waiting for you. As your portfolio grows, you will constantly see people online showing enormous dividend yields and claiming they've discovered the secret to easy passive income. Some will tell you that a 10%, 12%, or even higher yield is the fastest path to financial freedom. But remember this: yield is simply a relationship between the dividend and the investment price. If a stock's price collapses while its dividend stays temporarily unchanged, its displayed yield can suddenly look enormous. That doesn't mean the company became a better investment. In fact, the falling price may be signaling that investors are worried about the company's future. A dividend can also be reduced or eliminated, so before buying anything, look beyond the yield. Consider the company's earnings, cash flow, debt, dividend history, business model, valuation, and ability to continue funding the dividend. And this is the moment where the entire strategy becomes much clearer. You are not trying to build a portfolio that looks impressive on a screen. You are trying to build a portfolio that can survive reality. Markets will fall, companies will disappoint, interest rates will change, recessions will happen. Some investments will outperform and others will struggle. Your job is not to predict every market move. Your job is to create a financial system that you can continue following when the market gets uncomfortable. If you're starting with zero today, your first milestone could simply be your first $1,000 invested, then $5,000, then $10,000. After that, you can focus on $25,000, $50,000, and eventually $100,000 and beyond. Every milestone represents more than a number. It represents another layer of ownership. And as your portfolio grows, you can decide whether you want to reinvest dividends, use some of the income, or adjust your strategy based on your financial goals. The most important thing to remember is that a $1,000 a month dividend portfolio is not a get-rich-quick scheme. It's a long-term wealth-building project. You don't need to predict the next Amazon. You don't need to trade every day. You don't need to stare at stock charts for 6 hours. You need to save consistently, invest intelligently, diversify, understand the tax implications, control unnecessary fees, and give compounding enough time to work. And if your income increases over the years, try to make your investments increase with it instead of allowing every raise to disappear into lifestyle inflation. So let's come back to that original question. What would it feel like if $1,000 appeared in your investment account every month without you having to work an extra shift to earn it? The real power isn't the $1,000 itself. The real power is what that $1,000 represents: assets you own producing income for you. Today, you might be starting with $0, $500, or $5,000. That's okay. Every large portfolio started much smaller than it is today. The goal isn't to become financially independent overnight. The goal is to make your future self richer, month after month, year after year. And if you stay consistent long enough, the day may come when you stop asking, "How much money do I need to invest?" and start asking a much more exciting question: "What do I want my money to do for me next?"